Cathie Wood's ARK fund was the highest performing fund in 2020. With the recent dip in 2021, some of you may be asking, should I buy the dip? And my short answer is no. But that answer may not be enough for some of you. So let's explore her top 10 holdings and see why I don't like this fund. So drop a like on the video if you appreciate me giving you the short answer up front. Anyway, let's see why ARK is falling. So in my opinion, of course you don't have to agree with this, ARK is falling because of a simple reversion to the mean. Companies over time will trade at their fundamental value, being that any investment is the present value of all its future cash flows. So ARK being the highest performing fund in 1 year makes it a lot more difficult to be the highest performing fund in the next year. Basically, I believe that it was way overvalued. People got sucked into ARK chasing performance. And as you know, the more overvalued a stock gets, the lower your expected return should be. For example, if you bought Microsoft at 100, you would be doing pretty well today because at 100, it's pretty darn cheap based on how much money it earns. But if you buy it at like 300 something, then you wouldn't be expected to make as much money as if you were purchasing it at 100. Pretty simple, right? Like if you ever played fantasy sports, it's just like picking up a player that you never heard of just because he had one good game. But that one good game already passed, and any value you could have got out of him is lost. There's a reason that averages are averages. In this case, you can think of a linear line as stock performance, and as you know, the market doesn't grow in a linear fashion. Sometimes it'll be overvalued, sometimes it'll be undervalued. I believe that a lot of the people who were chasing performance got stuck buying at the top here where it was overvalued, and now they're stuck paying the price. Ben Felix has a very good video explaining chasing top fund managers, and I'll link it up here. Anyway, let's actually get to the top 10 holdings of ARK. So as you see, here are the top 10 holdings. ARK has actually performed quite well from March 2020, but whoever bought up here, feel kind of bad for you. Because this line here says that past performance doesn't guarantee future results. Just because a fund is hot doesn't mean you have to chase. So before I look into these companies, just know that I'm going to be looking at numbers, and if you wonder why I'm doing that, it's because there are thousands of stocks in this world and I don't have enough time to just look at them each one at a time. Otherwise, I'll have a really hard time finding a good investment. If the numbers don't intrigue me, then I won't look further. If you look at all these stocks in the past year, the only one that's still up is Tesla. So needless to say, this fund has been crushed because of that, because it's not really diversified. The top 10 holdings make up over half the fund. Being so heavily concentrated in the top 10 holdings means that this fund will be very volatile, which is fine for some people. So the first stock is Tesla. It trades at a $947 billion market cap. And if you look at the financials, its net income is only $3.5 billion. That's like a 300 price to earnings ratio. So currently you're paying $300 for every dollar that Tesla earns. And for those of you that say that it's going to grow and eventually grow into that $1 trillion valuation, just know that you're already paying $1 trillion for it today. So your expected return for this stock is not going to be very high. And if you look over time, it does dilute the shareholders, which is another thing that's not very good. That means your percentage ownership of the company will continue to go down as they continue to issue shares. And as for free cash flow, it only does about $1 billion in the 2020 year. Let's just give it the benefit of the doubt and say it does $2 billion. So that's a doubling from the previous year. And even then, $2 billion of free cash flow, I don't think it really warrants buying this company at $950 billion. That's just what I think. Like if I showed you my YouTube channel and it makes like $1,000 a year, you would probably be okay with paying like $5,000 for it. But what if I asked you for $1 million? You probably wouldn't take it. You would only make your money back in 1,000 years. Assuming that my channel doesn't grow, which it probably won't because it's pretty slow, but you get what I mean. You're massively overpaying for this company, even if it does have growth, which I agree, it does grow pretty fast. But as it grows larger and larger, it becomes harder to grow. Just look at Apple and Microsoft. When you're working with bigger numbers, it's harder to move the needle. Anyway, let's move on to the second stock, which is ROKU. Trading at $20 billion, and also it has a 70-something price to earnings ratio, so that's already pretty high. And it only makes like $260 million in free cash flow, which pretty much means that you're paying almost 77 times free cash flow to buy this company. Like, I understand that these companies will grow and stuff, but if you're paying that much for it right now, chances are you're probably not going to get a great return on your investment. Anyway, so TWLO's the third stock, and it trades for like $11.6 billion. It doesn't really make money at all because its earnings per share is negative. And if a company is not really making money, I don't really know how to value it per se because it doesn't actually earn any money. So currently I wouldn't buy something like this. Like previously I would because I got sucked into this hype and growth stuff in the past, but now it really doesn't make sense to me. Like if a company doesn't make money, you can always wait for its profitability before you actually buy it. Because this company doesn't actually make any money, it's not very interesting to me. Also, I did read this company's 10K because in the past I was looking at this company, but now I changed the way I look at companies. I look at the numbers first, and if the numbers actually make sense to me, then I'll look at the company. So if I remember correctly, this company actually spends a lot of money on stock-based compensation. So it spends so much money on this, which I really didn't like because that means you're not going to have any net income if you spend that much. Of course, this could be temporary. I don't remember if it was or not, but if a company is not profitable, then count me out until it is. And if you come and say, well, if you buy it when it's profitable, then everybody else is going to know about it already. Well, to that I say, you can always look back at the example of Amazon. Amazon, back in the tech bubble, it was like $100 something, like 116, 108, somewhere there. Yeah, 107, somewhere like that. And at that time, if you look at the past, it was not profitable. But if you waited until 2003 when it fell like 80 or 90%. So you could have gotten an even better buy point when everyone else was not hyped. Because at that point in time, everybody thought that .com companies were the future. That kind of sounds familiar because a lot of these companies that ARK is pushing is advertised as disruptive innovation, which disruptive innovation is cool and all, but I'd say that even if these companies are growing very fast, it's possible to overpay for growth. Another example of this is Intel in the .com bubble. It still hasn't reached the same stock price as it did back then, and it earns over double the money that it did back then. 21 billion, 10.5 billion. So it's always possible to be overpaying for growth. Anyway, let's move on to the fourth stock, which is Zoom. 40 price to earnings. It's not as bad as the other ones, but I still think it's overvalued because I personally think that even if we do continue using Zoom in the future, the growth of this company was actually heavily spurred on by the pandemic. If you look at 2019 numbers, it went from 2019 doubling in 2020 and then going like up 4 times. So I don't think that that's very sustainable. So I think that the price to earnings number is actually quite, I don't want to say inflated, but like skewed lower. So it makes it look better than it actually is. Well, at least this company does make money. I'll give them that. But $1.6 billion in free cash flow, trading at $44 billion. What is that as a multiple? 27.5. It's not as bad as the other ones, but I just don't see this happening every year. So that's why I don't think that this is a great company to buy yet. So I want to see more data before I jump into something that just went up 4 times in revenue the previous year. Anyway, this probably is not a stock for me, but if you guys know anything more about it, then you make your own decision on this one. And the next one is Coinbase. Oh, a crypto platform. It has a good earnings per share, almost 10 billion in free cash flow. In terms of those metrics that I was looking at, this looks cheap. But for me, I personally don't think crypto is a great investment. So since I believe that crypto is fundamentally worthless, that I wouldn't buy something like this. Again, that's just what I think. You don't have to think the same thing. Because by numbers, this looks cheap. But in terms of the company itself, I don't really want to buy something like this. Anyway, let's look at Unity. It doesn't make any money yet. Trades at $31 billion and negative $100 million in free cash flow. Of course, you can say that they're investing and stuff, but the operating cash flow is negative. So I'm just trying to go through this as quick as possible so it doesn't get too boring, you know? So I just want to say if the company is not profitable, you can always wait. So Spotify is not making any money, so I can skip that. TWLO is not making any money, so let's just skip through. Exact Sciences, not making any money. And then UiPath. Like I heard of all the other stocks, but this one's new to me. Well, not very surprising. It doesn't make any money. Now, why is that? Operating expenses very high. SG&A again, sales and marketing, and then R&D. But yeah, so 6 out of the 10 companies in her top 10 holdings don't make any money. So it really makes sense why this ETF has been falling in the past year because people are starting to move out of less speculative assets like these ones. And going back to the Amazon point, you can always wait for the companies to be profitable in order to start looking at a company. Because for me, at least, if the company doesn't make any money, it's hard for me to actually put a number on it. And another example of this is Walmart. You can look into it yourself. But in my opinion, I just think that ARK as an ETF is just very well marketed. When you think about it, Cathie Wood is a very good salesperson. She uses these keywords like innovation, disruptive and innovation together. And then she makes it sound very professional. Of course, I'm pretty sure that they do some research, but I'm not sure how that process goes because a lot of the companies are unprofitable. I mean, it used to be worse. In the top 10, it used to only be Tesla and like Square that was profitable, I think. Correct me if I'm wrong. But when you think about it, if you buy into these funds, the ones that are getting screwed are you when it goes down because they collect that 0.75% expense ratio. If you look at her other funds and you add them together, she's managing $30 billion. It used to be 50 something billion half a year ago, but 0.75% of 30 billion is like 220 million, I think. Yeah, 220 something million. And when you think about it that way, it doesn't matter if the stocks go up or down, they're still collecting the 0.75% expense fee. So when you think about that, that's why I don't like these actively managed funds like ARK. So if any of you have watched Wolf of Wall Street, this is like that scene where There's a dude that was like,
fuck the clients. Name of the game, move the money from your client's pocket into your pocket.
So that's what I think about actively managed funds, because usually they charge a much higher percent than 0.75, but 0.75 is still high nonetheless. If you look at passively managed funds, they're like 0.1 or 0.08 or something like that. Some of you may be thinking that a 0.75 expense ratio doesn't make that much of a difference, so I'll show you. Let's just say you start this year and you're contributing $6,000 to your TFSA every year. Let's just say that the 0.75%, and you calculate. That's like a 20% difference between your retirement money in one case and your retirement money in the other case. Of course, other mutual funds would probably charge like 2% more than a passively managed fund. That'd be like damn near 50% difference. Anyway, that's pretty much all I had to say about ARK's holdings, why I don't like them. So if any of you guys are asking why am I hating, I tend to think that I'm not, but just in case I sound like I am, I'm just trying to give you another opinion for you to think about before you make an investment decision. Because in my opinion, I just don't think this one is a good idea. Because one, you're chasing high performance, and two, the companies are not very profitable. And even if they are, they're very overvalued. Maybe except for Coinbase and Zoom. But then Zoom had an anomaly year, and in my opinion, crypto is worthless. So those aren't for me, but for the most part, the funds companies are not very profitable. And if some of you still say that I'm hating and that I don't understand growth or innovation, just know that I bought Tesla in the 2020 dip and I made quite a bit of money on it, but I will be the first to admit that I was lucky on that because Tesla is pretty wildly overvalued. And I'll say that if you had gains with this ETF in the past, you probably got lucky too. I'm just trying to say that I did have a phase where I did believe what Cathie was saying, but I started to have my doubts here and there when I started to look at the company's numbers and what she's investing in. If you think back about Amazon, back in the speculative frenzy of the dot-com bubble, you can always wait for a company to be profitable before you invest in them. And that's what I think about the Cathie Wood Fund. Buying into this fund is just way too early for some of these companies. So then some of you may turn around and ask me, why don't you short ARK then? And to that I say that the market can stay irrational longer than I can stay solvent. Being that in last year, the market could have kept going up and up and up. And if I shorted it back then, which looks like a good idea in hindsight, I could have gotten myself screwed if it didn't go down. There's just too many intricacies in timing when you're shorting a stock. With these terrible fundamentals in the ARK fund, it was bound to have a crash, but who knows when that would happen. I don't know when that would happen. If I knew, then I wouldn't be standing here making videos. I would just keep it a secret to myself. And to add on to that, I'd say that it's easier to earn money than to keep it. So before you think about all the upsides of innovation and disruptive growth, you should think about the downside first and how to protect it so you can keep your money intact to compound your wealth over time. Maybe the answer isn't enough for some of you, and some of you may turn around and say that I'm dumb and I should just short it with options instead because you don't have to add any more money to continue your short. Well, to that I say it's pretty much the same idea. I don't know when the market will crash. I don't know when ARK will crash. I don't know when things like these will happen. But I know that over time, companies will trade at their fundamental value. If I don't know when stocks will crash, then even if I could get it right theoretically, I can just as easily get burned. So that's why I'm always long equities, because there's no set time frame. So you can always wait until you're right. Anyway, that's about it for this video. If you did find it helpful, make sure to drop a like on the video and subscribe with post notifications on so you can see more videos from me. See ya.